Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, January 27th, just after the close. I'm here with the Moose, CEO John Mousseau, Director of our Fixed Income Department. In terms of equities this week, that growth bid remained.
Yep.
You know, we've been talking about it for a couple of weeks. Sometimes those beaten down sectors are the first to react. That in the past has tended to start to work its way through near the end of January. We'll see what happens. We were busy in our US ETF strategy this week. Gold miners, what a run.
Yeah, really run.
Put that on almost holding our breath a couple of months ago. You know, a 20+% move. We did take that entire position off. We left the silver miners on. We'll see what silver miners do over the next couple of weeks. Semiconductors, decent trade. Sold that, replaced it with additional energy pieces. So in our US ETF, the three big sector overweights are healthcare, defense, and energy.
Right.
Outside of that, fairly diversified. In terms of fixed income,
I got to tell you, sometimes a boring week is good. And what we had was kind of a week where not much moved. The 10-year Treasury started the week at a 350, ended the week around a 350, 2-year the same way. And it's kind of like in a range, right? And what did we have today? We had the PCE, the personal consumption expenditure. That is the inflation number that the Fed pays lots of attention to. And the monthly numbers were pretty good. The month-over-month number was 0.1, the core number was 0.3, and the trend has been down. And that means that the markets are thinking that the Fed will start to calm down a little and maybe only go 25 basis points. And the idea is that the end of the rate hikes, which were not in anybody's horizon a few months ago, are now starting to appear on the horizon. And that is good for stability in bond yields. And that stability in bond yields obviously can help the stock market a lot too.
Yeah, multiple asset classes.
Absolutely. Right? And one thing you can tell, and we haven't had this at all, we've had 3 weeks in a row of inflows, not huge, $1.5 billion to $2 billion, but 3 weeks in a row of inflows into bond funds. And that is a welcome sign.
Yeah, we talked about that with Sean last week,
right.
How yields have come down, demand has come up.
Right.
Versus, remember back in October, November, talking about those 5%
yeah, they're not there anymore, but you know what? Four is still pretty good.
Yeah, hey, that's golden versus the last decade.
Absolutely. It's a very good yield, and when you look at the taxable equivalent on that, it could be anywhere from 6.5 to 8, depending on someone's tax bracket on a state level.
Yeah, no doubt. Next week, we'll take a look at where some of the weekly momentums have gotten to. You know, we looked at that back in December when we were trying to find a spot to add a little cash.
Right.
Momentum was getting very oversold. Now some areas, and specifically growth areas, are starting to push up to that upper band where we need to be cautious and think about either lightening up on some of the growth or at least pulling back on an allocation.
Right.
So that'll be interesting to take a look at. Quick note, coming up next month, the next in our series of Ukraine-Russia, this one specifically Ukraine 1 year later. You can attend either in person or online. For more information, click the link below. Would love to see you there. Don't forget to like, comment, and subscribe so you can follow along weekly. Enjoy the weekend. We'll see you next week.